In this video, traders, we're going to look at 3 ways to trade a market gap. Stay tuned. Hey guys, a very warm welcome to you. All right, so this video is sponsored by Core Spreads Australia. There's a link to those guys in the description below for your spread trading. Go check out their Core Trader 2 platform, decent chance. Most importantly, guys, for traders, right? Nice, tight spreads. Link below, go and check them out. Okay, so 3 ways to trade a market gap. Now, gaps aren't necessarily just on stocks. Now officially, you've got the closing bell, right? So we're looking at Tesla, for example. Bell goes, market opens. If the change in open to close is 2%, we've got a 2% gap up or down. We get the idea of that. However, we also have Sunday night gaps with forex, but we also have, even though the indices, especially some of the more popular ones, will trade throughout the evening and are available for you on the Core Trader 2 platform, they are actually gapping when you consider the cash session. So, for example, 8 a.m. UK time, FTSE opens, DAX is open, off we go. Now, that is the bell, so to speak. That's when the stocks will start trading, 4:30 finish. So between 4:30 and 8 a.m., if the market has moved, then there's going to be a gap. Now, yes, it's 24-hour trading. However, we can still consider that to be a gap. You know, very often, US session might gap up. US session might gap down based on news coming out overseas in China, etc. So even though we see a 24-hour chart, we've sometimes got to look and see, okay, where is the current price at 2:30? I'm talking from UK time. Obviously, look at your own time, wherever you are in the world. But you say, okay, I'm looking at that. I'm also looking at the closing price, and is there a gap accordingly? And then trading that and imagining that as a gap. So, okay, we are 100 points up, let's say, on the Dow. Close was here, 100 points higher. So even though we've seen the chart overnight do this, it's still technically a gap because everyone who's seeing the actual stocks, and that's what's based on the underlying cash, Dow, it's based on the 30 stocks, of course, we see that as a gap. So it's not just restricted to stocks. So anyway, 3 ways that we can potentially trade gaps. And I'll give you some ideas on my thoughts. And again, no advice or anything like that, guys. It's literally just my opinion on stuff. Definitely go and kind of open up a demo account, link in the description below, have a look at some charts, play around, just see if you can see any patterns that kind of work for you with your time frame and the markets you like to trade. Okay, so first one is this kind of gap, drift and drive. So we get a gap up. These are all gap ups. This is the closing price here, just for clarity, and we've all gapped up on all of these just to keep it simple, but it works similarly in gaps down, although some slight nuances with gaps lower. Can be a little bit more aggressive, a little bit more fear, especially for trading stocks actually, and indices, because the fear of kind of loss of investment money is a little bit greater generally than kind of shorts getting trapped. But that's by the by. Let's look at the broad patterns. Gap up, and then we might see the first kind of 15 minutes or so just sit there and not do much, maybe even drift lower. So we kind of bracket ourselves and go, right, there's our high, there's our low. Try not to rub out these excellent candles. We've got a high and our low, and it sort of drifts there, and then it finally kind of kicks into gear. And if you're tracking volume, you might kind of see this, bigger volume coming in as it starts to push higher. And that's really, think about what's happening there. It's basically a situation where, right, buyers are, okay, let's see if we can get it lower. Can we get it at a lower price? Can it come lower? Can it come lower? No, it can't. And I can't wait any longer. I'm gonna have to buy. And then they buy, and that buying triggers more buying, triggers short covering, and then we get the rally, and that's the rally that we're looking to kind of follow. So if you can, you can look about some sort of breakout trade out of that high, or if you can find better, if you can find some kind of bottoming pattern here, and maybe going above the high of the lowest 5-minute candle, a little bit earlier, slightly more risk, but you can manage, a stop under that low and trade it like that just to protect you from full reversal. Okay, so the other one is that we have literally the bell goes and it just goes thump. And very often we see this, guys, especially on bigger gaps, especially on catalysts, when there's some sort of news has come out overnight that's repriced the market, it's gapped up or gapped down, just opens, just goes bump, see you later, and just rips. And normally it's people who are so panicking, they've got to get in, they've got to get out. And you very often just see 2 strong, huge candles moving to the upside. If we're talking about 5 minutes, 2 5-minute candles are very, very strong, followed by 2 very small little red candles, just pausing, not pulling back at all for the drive, just waiting to see any sellers, buyers. I think I've bought enough. No sellers, bang, back on the throttle again, boom, to the upside. Now, very hard unless you are kind of good at reading sort of short-term price action and tape to jump on this. A more structured way of doing it is to wait, let that go as long as it wants to. You know, don't chase it, because very often you can get caught at the top and then you get stopped out in the pullback, and then in the worst case scenario, because you were right but you were wrong, and nothing worse than that. Waiting for that kind of pullback, pause, consolidation, breath of fresh air, spring just kind of contracting a little bit, and then when you start to see it go again, then you start to see, you know, the strength coming in again, and it starts to break out of these high, or starts to break a little trend line there, then you're off and you're away. And bear in mind, you know, you've gapped up quite heavily from here, and it's just literally pushing through the gap. And the final one, guys, is the gap fill. Now the gap fill is, you know, I used to say that the gap's filled quite often, but much more now I see is that they fill later on. So you might say even on day 2 or 3, so you get a gap, you get a drive, you get a consolidation, then maybe something comes down, it kind of drifts lower, then it goes up again. So don't always fill on day 1, guys. And that's a bit of a myth, I think. And it's, you know, as far as just my eyeball, I've not done any research or statistics to confirm that. So, you know, take it as such. But just from kind of the stuff that I watch, you know, filling the gap, unless it's a very small gap, of course, and it might just kind of trickle down. If it's a, let's say, a 20-point gap on the Dow, it might just trickle down and close that. You know, they're generally not the case. In fact, it's probably worth mentioning that, you know, if you're quantifying the gap size, you know, if we're trading a bigger gap, we're more likely to get this kind of action, a continuity type trade. So if we're gapping, let's just use the Dow as an example. If we're gapping up 100 points, say, on the Dow, then, you know, this might be more likely because it's trapped a few shorts, it's upset a few things, it's repriced the market a little bit, it's changed the game a lot, as opposed to 20-point gap, which is nothing, it's just noise, in which case you're probably not going to be looking for that. The order of magnitude of the gap is quite low, and you might be looking more for the gap fill. But then, is there enough meat in it anyway? 20 points, by the time you kind of get in it, you might only be able to take 10 points out of it. But that's up to you to decide and work out where these, if any, fit in with your strategy and the way you approach the market. But anyway, the third one, guys, is the gap fill. But very often you won't just get a complete drop through the floor. Sometimes you do, and sometimes if you're kind of quick enough and jump on it, then fine. Again, keeping the risk managed, all that kind of stuff. But very often you get an attempt to push higher, but it kind of worn out. It's worn out, and often you might get this after multiple days. Let's say 3 days of good strength, final gap up. It's just tired, man. The bulls are tired. They've done all this work, finally gaps up, and they're like, listen, no one wants to be buying up here. We've had 3 days of rally, and you know, they're fed up. And that's what happens. They just get tired. There's some profit taking. It's not going to necessarily lead to a massive sell-off, but it just fills the gap. So you get a gap up, 2 candles pushing up, maybe get a little bit of a wick to the upside, starts to reverse, doesn't really get going, not really strong volume like you'd see in these kind of things here, really doesn't start to kind of stretch things, looks a little bit, you know, pathetic really when you're looking at it on the chart, starts to roll over. And then if you're managing that kind of short position, you know, you can work a stop potentially off that high or whatever else fits your risk criteria, risk parameters. So there's a couple of ways, well, 3 ways to trade a market gap. Like I say, this video is sponsored by Course Spreads Australia. Go and check them out. There is a link in the description below, guys. If you want to check out their demo platform, open up a demo, have a look around the website, and then please do so. Take care. Bye-bye.